Let's bring in Ben Emons, who's got a few topics on his mind. We're going to hit three of your latest notes, Ben. Let's start on the macro side. Ben's Managing Director of Global Macro Strategies at Medley Global Advisors. When we see what the Fed's doing right now, Ben, you've been writing about yield curve control. What does that mean? How does it fit into all the purchases that they're doing?
Hey Oliver, great to see you again, and good that everything's going well, right? We're back. We're still in
Thank you.
operating, right? Things are good.
Yeah.
Well, yield curve control, yeah, yield curve control is was first pioneered by the Bank of Japan. In summary, it's essentially saying we're going to target the 10-year yield at a certain range, and we're going to buy unlimited amounts of bonds there to keep it in that range. And then the yield curve becomes sort of a very static nature, like a very static phenomenon. And the Bank of Japan had the view about this, saying, well, this could actually thereby stabilize the economy, right? Because if you're keeping the yield curve quote unquote stable, then inflation expectations are stable, and what you can expect from growth and where interest rates are going. And in Japan that did work out to an extent, at least up until the COVID crisis. And now the big debate, of course, is that if that was effective, we saw Australia already following that example. That also the United States, maybe even Europe will do too. And I think yield curve control, yes, that could be a next step for Federal Reserve or ECB, but maybe in a different form than the Bank of Japan, maybe more on the short end of the yield curve.
So Ben, where was the yield curve control when in March, when everything was selling off, the bonds went haywire too? Should we expect then that type of event to be past us, or is that volatility suppressed? Seems like it is right now. The 10-year hasn't moved. I mean, other than this little gyration, 10-year is like it just shut down for the past month.
Yeah, it indeed did. And I think that it is partly the function of the way the language is put in the statement of like, we're going to continue with this policy until we weather the storm and until we get this whole situation behind us and the economy gets on track. Obviously, coming out with QE on March 15th and actually doing about triple of almost 4 times as much than what you had intended to do helped a lot. And then on top we had the announcement about the credit programs that was somewhat of a surprise in there to markets, that it was high yield included. I think that all combined helped interest rates to become very stable, and as a result markets start to revive. I think this matters, of course, but it's not the same as the idea of yield curve control, right? That would be more specifically announcing that you're going to target a certain interest rate, what was in that speech from Lael Brainard, that setting an interest rate cap, so to speak, certain level, and then making a message more stronger about like we're going to keep rates unchanged, and this is the level where we're going to keep it unchanged. And then I think from there volatility will only fall further from there. So we'll see if that actually happens. At this moment, I would say that the stability of long-term interest rates has been very helpful to financial markets.
You point out in your note the blog post on the New York Fed's website about this yield curve control. Is this something that we would hear specifically from the Fed? It's not something they do in the background of markets where they just keep buying every time yields get to some certain point. This would actually be a telegraphed and obvious thing.
Yeah, that's if you look at, there's two things that was published in the past. One about the Fed Accord, right, with the Treasury, that was pegging long-term interest rates. That's something that's been done before. And then I think in 2010 there was a staff that published a paper about it that was sort of laying out the mechanics of how they could go about it. But just in very simple, broad terms, the Treasury market is so large, right, that the ability to implement this policy is probably pretty simple, pretty straightforward. And it is not something like a foreign exchange intervention, right? But it's really like you're actually announcing a cap on interest rates, and the market believes you that you will keep it at that level. Every time the yield will go above that cap, there will be unlimited buying, and the market knows that, so therefore it will stay at that cap or below. And that's what the Bank of Japan achieved as well. So that I think will be straightforward. What's more important, I think, from that analysis is to say, if you are announcing interest rate caps in the future, you're going to say something about the what we call the neutral rate, right? The rate where the economy doesn't move a whole lot. It's stable, inflation, growth is all stable. And that is at the moment highly uncertain, right? We're in such a contraction phase the numbers are coming out now, like for example, durable goods today, and later on this week with non-ISM and payrolls will show that we cannot really say anything about a neutral rate, right? We're in an economic environment where we still have to figure out what's the trough here of what's the bottom exactly in the economy before we can make statements about anything that could be neutral. So I do think that financial markets are sort of feeling that this bottom is building slowly but surely as we try to reopen the economy, but it's going to take a long time. And this is, I think, why policies like yield curve control are under consideration, whether it's here or Europe too, by the way. But it's going to take some time.
Ben, I think this is going to be really important. I think it's a good heads up for our viewers here on what to keep in mind as the Fed continues to get creative. I want to shift gears to your other point, though, because you put a big note out about airlines. And usually, Ben, from what I know about your research, you're usually doing macro stuff and you're getting stock specific. So I want to make sure we hit this. I like this. Why airlines? Because I know you write about Buffett basically saying that he's not a believer anymore in these, and that actually maybe there could be a potential turning point if, again, the big if is if there's some stability in our behavior.
Yeah, that's right. And I think, of course, Buffett is highly followed, right? Everybody listens to him, and I think investors respond immediately to what he says and basically do the same. So the airlines are down now today. Well, I can see now it's actually less than what it was earlier. But I think that investors probably reacted to his decision to get out of the airline sector. What I found notable there is that we've already had a government intervention in the sector, right? The Treasury has put out a bailout package, and although not every airline took the exact package, right? Some have taken an equity stake, some have not. Some take more loans, and some are more eligible for the Fed program. One exception there is Boeing, right? Which he, by the way, did not have a stake in, but Boeing actually could stand on its own feet, right? And it's interesting that that company actually is being highlighted as more systemically important by the administration. Now, taking it all together, I think if you look at what he said over the weekend, then it's of course discomforting that a sector like airlines, which is really important to the US economy, will just have a future that is so bleak and dismal that the recovery of it is so uncertain, even more uncertain than the recovery of the economy itself. I do think that the administration is quite convinced that this sector has to be stay in operation, right? It has to survive. And
Yes.
if you know that as an investor, it would likely lead to consolidation. It likely lead to some sort of restructuring of the sector, but ultimately it will not disappear. So there will be airlines coming from this that will do a lot better, and will be the investment opportunities. I think you may get out a little too early.
I think that's an interesting point. If the airlines, because right now we see it. I mean, they're glaring. Even better. Even the energy companies have done better. Even some of the cruise lines have done all right. The airlines are getting punished the most by the stock market right now. So to your point here, maybe that'll force a more stringent view on balance sheets and cost-cutting. Ben Emons, really like the take here, giving us the heads up on what to look for from the Fed and in airlines. The third topic, we're going to come back and hit again with Mr. Emons, and that is about repatriation of the supply chain here home and whether or not U.S. Tariffs might be the next conversation. Ben, always a pleasure joining us from Medley Global Advisors.